And let's turn now to the economy and a key interest rate decision expected today from the Federal Reserve.
The central bank has been battling to get inflation under control, but this is all happening amid ongoing concerns in the banking sector and volatility in the markets. NBC News business and data reporter Brian Cheung joins us now for more on this. Brian, good to have you with us. So first, what can we expect from the Fed today? And then will they give us any hints about what to expect after this month?
Yeah, well, the expectation is that they will raise interest rates again, 10th time in a row. This would be a quarter of a percentage point, and this would essentially be to handle high inflation. Prices now 5% more expensive than they were this time last year. The Fed wants to see that somewhere closer to 2%, which is the reason why they're continuing to raise interest rates. But we're going to be looking for commentary from the Fed Chair Jay Powell about whether or not this could be the last one. The reason being the concerns that we're seeing in the economy with potentially the unemployment rate maybe going up, compounded with the issues that we're seeing with the debt ceiling and, of course, the issues in the banking sector. So a lot going on that's really looming over this Fed decision.
And speaking of the banking sector, we had that regional sell-off yesterday. All of this, the Fed meeting is coming right in the middle of that happening. How does that factor in here? What do you make of that?
Yeah, well, there are a number of regional banks that, to be fair, are smaller than First Republic, which you'll recall went under over the weekend. But they were experiencing pretty harsh sell-offs in the stock market. Now, investors are not the same people as the bank depositors that have money at those respective banks, but nonetheless, it underscores these shock waves that we're continuing to experience almost 2 months after the failures of Silicon Valley Bank and Signature Bank in mid-March. So for the Federal Reserve, one of the issues is that higher interest rates was one of the contributors, not the main one, but one of the contributors to Silicon Valley Bank failing in the first place. So as they continue to raise interest rates, how do they do that without potentially breaking another bank? That might actually make the case for them after this rate hike today, possibly stopping.
So we're about a year now, hard to believe, into these interest rates hikes. What has been the impact on inflation? What's been the impact on consumer wallets?
Yeah, well, I mean, we're all feeling it, right? When you take a look at those rates that we have on the screen right now, credit card rates averaging 24%. These are highs that we have not seen in decades. Mortgage rates are very expensive. Car loans are also expensive. So to borrow money right now is extremely expensive. And that's the point of these higher interest rates. That's the reason for why they're doing this, because they hope that's going to take steam out of the economy, lower consumer demand a little bit to hopefully take those numbers down. So Americans will continue to feel the pinch. But again, this is all in the goal of hopefully making those eye-popping prices at the store stop rising.
All right, Brian, breaking it down. Thank you so much.
Thanks for watching our YouTube channel. Follow today's top stories and breaking news by downloading the NBC News app.